Alright everyone, so welcome to another ICT explained and simplified video. In this discussion we are going to talk about market maker models. Pay close attention because this is a good one. Alright, so for our table of contents, we have one, introduction to market maker models. Then we have the flow of the market. Number 3, the consolidation phase, market maker models, trading strategies, the accumulation and distribution box. Shout out to Ali Khan, since he's the one actually coined this part, or claims to have coined it. Then we have time and market maker models. And then we have market phases and patterns. And finally, we have application and case studies. Let's begin. All right, chapter 1, introduction to market maker models. Defining what market maker models are and their role. So, market maker models are like game plans used by market makers. Think of market makers as the middlemen in financial markets. Their job is to make sure trading keeps going smoothly. Here's how they do it. They start by providing liquidity. They keep the market active by always being ready to buy or sell. This means there's always someone to trade with. Next, managing order flow. They handle the incoming buy and sell orders, which helps keep the market organized. Next is influencing market dynamics. Their actions can affect the way the market moves, quoting bid and ask prices. They're always giving out prices they're willing to buy and sell at. This helps traders know the going rate for financial product. Narrowing spreads. The spread is the difference between the buying price and selling price. Market makers try to keep this difference small, which makes trading less costly, which also means you get in at a really good price. Establishing market equilibrium. They help balance the market by matching up buyers and sellers. In short, market maker models are strategies to keep the market running smoothly, making it easier for everyone to trade. The two main models, the market maker sell model, focuses on transitioning from a buy program to a sell program for executing sell side delivery, while the market maker buy model focuses on transitioning from sell programs to buy programs for executing buy side delivery. These models help traders understand market structures, identify reversal patterns, and capitalize on trading opportunities within different time frames. Now, the importance of understanding market maker activities for traders. Understanding market maker activities is crucial for traders as it provides valuable insights into market dynamics, liquidity conditions, and price movements. Here are key points highlighting the importance. Liquidity access. Market makers play a significant role in providing liquidity in the markets, allowing traders to open and close positions easily and efficiently. This liquidity access enables traders to execute trades promptly with minimal hassle. Next is risk management. By understanding market maker activities, traders can better manage risk. Market makers help in narrowing bid-ask spreads. Heck, see what I did with there? Reducing trading costs and providing opportunities for quick trade executions, thus assisting traders in minimizing potential losses. Price movement interpretation. Market makers influence price movements and manipulate liquidity to create patterns and reversals. Understanding these activities help traders interpret price actions, identify trends, and make informed trading decisions based on market maker behavior. Next is market structure recognition. Knowledge of market maker activities aids traders in recognizing market structures, such as accumulation, manipulation, and distribution phases. So, before moving on, this is actually a good point right here. If you have not seen my previous AMD video or Power of 3 video, you need to watch that. You need to watch everything, as a matter of fact, that I have made before this video. Why? Because you will not understand this at the level of depth that you need to know. There's so much that goes into this that I kinda do not go into because you should already know. Like the AMD part. You should know what accumulation, manipulation, and distribution is and how deep it goes. So please rewatch that video. If you haven't watched it, you need to watch it and watch all of my other stuff before continuing on. because if you don't, you will not get this. All right, moving on. This understanding allows traders to anticipate price movements and align their strategies accordingly. Next is competitive advantage. Traders who grasp market maker activities gain a competitive edge by aligning their trading strategies with institutional players. By mimicking smart money moves and working in the direction of strong order flows, traders can enhance their trading performance and reduce risk exposure. Market efficiency interpretation. Market maker activities provide insights into the efficiency of the market. By observing price adjustments to new information and exploiting inefficiencies, traders can capitalize on price discrepancies and make profitable trades. In essence, understanding market maker activities is a cornerstone for traders looking to navigate the financial markets effectively, make informed trading decisions, manage risk efficiently, and gain a competitive advantage in their trading endeavors. All in all, guys, market maker equals good. Okay, so you have two types of market maker models. You have the market maker sell model and the market maker buy model. Don't confuse market maker sell model with sell program, and don't confuse market maker buy model with buy program. So for the market maker sell model, it starts with a buy program to sell program. So this area right here, all this is what's known as the buy program, and all this area right here is the sell program. Its main purpose is to engineer buying liquidity. In other words, its main purpose is to trick you into buying once it's going up. That's the main purpose. Now, some people do capitalize on the buying part. The problem is the sell program can initiate at any moment. That's why it's a little risky. It's better to just sell once the sell program starts. Number 3, this model is looked for in bearish higher time frame conditions. And now it doesn't always need to be only higher time frame conditions. It could also be on the same time frame. But generally, you would want to do this on a higher time frame. Now, number 4, once the buying program is finished, its next target is the liquidity resting below the initial consolidation. So this is the consolidation part. The consolidation might not even begin right away. I'll show you a few examples of what I mean, but it's not always going to consolidate at first. The buy program will start and then it'll consolidate here. But again, I'll go into a little bit more depth in a minute. But yeah, generally, it's supposed to consolidate first. And then once it reaches that higher time frame PD array or that buy side liquidity, whatever, it can reach any point of interest really. The buy program completes here, and then that sell program initiates. So it'll start reversing, takes out maybe some liquidity on this side, maybe pulls back or consolidates, comes down, pulls back or consolidates, and then goes down, targets that initial consolidation here, or maybe it's a consolidation around here. And then the same thing here for the market maker buy model. You have a sell program, so you go down, up, right, that consolidation, and then goes down, reaches that PD array or that point of interest. The sell program ends, and then the buy program begins, and that's when you start entering your buy position. So real quick, let me pull out some tools real fast. So what I mean by higher time frame bearish conditions or higher time frame bullish conditions, all it is this: you just trading with the trend. That's literally all it is. So you have your down, up, down, and so this part right here, once it starts going up or starts creating that pullback, basically, that is when the buy program initiates, and it's looking for that higher time frame or same time frame point of interest. And then once it reaches it and it's satisfied, then that's when that sell program begins. And then here, same thing. So you have higher time frame or same time frame bullish momentum. Once you start seeing that pullback getting created, that is the sell program initiating, right? And then we're going into that point of interest or that liquidity, whatever, taps into it, and then that buy program initiates going up. So hopefully that clears that out. All right, chapter 2, the flow of the market. A brief overview of the 4 main patterns of the market. So again, if you haven't seen my previous videos, you need to watch it because I will not explain this all the way in depth. I'm just going to give you a quick overview. So for price delivery, you will usually have a consolidation, and then price will expand. It'll either go up or it'll go down depending on the trend, but the point is price is going to essentially break out of that consolidation and expand. After it expands, price will do one of these two things. It will either reverse or it'll retrace. If it retraces, it will continue expanding, or after the expansion, it could also do a reversal. And if it is satisfied with the liquidity it took, it will then reverse or initiate that reversal and continue going down. Now, there are two types of reversals that ICT likes to use, which is that sweep of liquidity or that break of structure, or sometimes it really just is a sweep, right? A wick. It wicks out whatever liquidity was behind it, and then it goes down, creating a change of character. And then a type 2 would just be a failed break of structure, or price fails to create another high or another low, depending on the trend, and then it causes that change of character. But typically he likes using a type 1, and we will get into that a little bit more. But for now, just understand there are two main types that he likes to use, and you have to get yourself familiarized with this. Again, look at my previous videos. I think it's the first episode, if I'm not mistaken. So check it out. I'll go into depth in that video if you look at it. Now we have initial consolidation for the market maker sell model. So when it comes to the market maker sell model, we have that initial consolidation, right? Buy stops accumulate up here and sell stops accumulate down here. The purpose of this consolidation is to build liquidity on both sides. Now, those reversals I was talking about, there's more than two, but they appear either in the consolidation or at its peak once it reaches that program or the higher time frame PD array and then initiates that program. So in this case, it would initiate that sell program. That is where you will see those reversals, either type 1 or type 2 or one of these right here. Now for the type 1, this is what you will typically see. So as you can see, you have your buy stops, then you have your sell stops, and then it'll either sweep the liquidity in the bottom, it'll tap into a higher time frame array, or it doesn't have to have a higher time frame array or an array on that same time frame. Sometimes it'll just sweep it and then it'll go up, initiating that buy program. Now it could also just sweep the buy stops, retest that level, and then continue going up. Or what you could also see is a sweep of the buy stops, comes back down somewhere in the consolidation, and might not even sweep the sell stops. Sometimes it will, sometimes it won't. But what it'll do is it'll bounce around here for a little bit and then start that buy program. And now here's where you will see a little bit of both. That initial buy stop to that initial sell stop. Afterwards, it'll either tap into a higher time frame array or some kind of point of interest, don't matter, and then it'll initiate that buy program. So pretty easy, right? Now we have consolidations for market maker buy model. So again, buy stops here, sell stops here. The purpose is to build liquidity. Now, as you can see, we have that initial consolidation up here, which you will see those reversals, or you can see them right here. I'll zoom in for you. Right here is where you will see one of those reversals. Now, again, you will hit your higher time frame array or some kind of point of interest, sweeps that liquidity, then starts going down to initiate the sell program. Again, here, liquidity on both sides. Might not even take anything out. It'll just initiate the sell program, taking out the sell stops. Here, you'll see it takes out the sells, goes back into the consolidation, and then finally goes back down. And this is where you'll see a little bit of both. Takes out sell stops, then takes out buy stops, taps into that higher time frame array or same time frame array, don't matter, and then initiates that sell program. Now let's talk about that initial consolidation in depth. So I want you to look for candles in a range that can occur after a run on liquidity from either side, although a run on liquidity isn't absolutely necessary. Look for equal highs or lows depending on the trend / model, above or below the range. Look for equal bodies at the lows or highs depending on the range / model. So if you're in the market maker sell model, you would want to look for like a type 1 model. You would want to see a run on sell side. Why? Because you want it to go up. If you're looking at a market maker buy model, type 1, you will want to say a run on buy side. Why? To go down. Now this is how you would initially want to see, or how you would like to see the consolidation. And here are just a few examples. So you can have it from body to body, or you can have it from body to wick, or wick to wick, so on and so forth. There's so many ways that you can pair this up, so you can find that consolidation and say, okay, it's consolidating here to here, or here to here, or here to here. Or if you find another type of image or another type of consolidation, the wick could be from here all the way to this one. It doesn't matter. Typically it is preferable to either have it from wick to wick or from body to body. It's up to you and however you see fit and however you see better progress, because at the end of the day, everybody's different. So if you seem to do a little better finding them from wick to wick, you do that. If you see finding them better from body to body, you do that. Doesn't matter, just as long as you're good at spotting that consolidation and the consolidation from all the other parts of the sell program or the buy program. And you'll see what I mean about that in a little bit. Now, before moving on, I actually want to clarify this part a little bit more. So what I mean is, usually after a sell program or a buy program, another kind of consolidation will start forming to initiate another either market maker sell model or market maker buy model. Now there's a few other stuff. The consolidation goes into play in other parts of the buy or sell program, but usually that is what this means. Okay, just wanted to clarify that part up. Now let's talk about market maker models on the higher and lower time frame. So this is part 1. So here you have your higher time frame bearish condition, and then you'll have your higher time frame bullish condition. So this is for the market maker sell model, and this is for the market maker buy model. The market maker model can appear on the same or lower time frame. So let's say you have that higher time frame array, you have that accumulation, you're going up, and then once it reaches the higher time frame array, again, it can be literally anything. A mitigation block, an order block, or you could even call it a supply zone, whatever you want, I don't care. Once it reaches it, it'll complete the buy program and initiate that sell program. Now here, price won't always accumulate from the very bottom or top, this top right here. Sometimes it will sharply reverse and then start the first stage of accumulation. Now for the market maker buy model, you can have that bullish higher time frame condition. It could be on the daily time frame, for instance. You can go bullish, up, down, up, and then you have that consolidation, breaks out, going down all the way into that higher time frame array. It can even be a fair value gap, and then it'll go up, creating that buy program. Now here is what I mean by price accumulating in these programs. So when price breaks out of this consolidation, or at least for example on the market maker sell model, once price starts entering into that buy program, these pullbacks can actually be accumulation zones, or they can reaccumulate instead of just being pullbacks. So it'll reaccumulate, which would be the first stage of reaccumulation, expands, and then reaccumulates, which would be the second stage of your accumulation, taps into that higher time frame or same time frame array or point of interest, initiates that sell program, comes down, takes out that second stage of reaccumulation or that pullback, whatever happens to form, creates that first stage of redistribution, because it's redistributing down now, but it could also be reaccumulation, no matter, but in this case it is called redistribution. It expands down. Once it takes out this set of reaccumulation, it'll consolidate and then goes down into that liquidity that was engineered in the bottom right here, which would be your TP or your take profit 1. And then same thing here for the market maker buy model. You can have price going up, right? It starts accumulating, sell stops and buy stops start accumulating, starts going down, starts accumulating or reaccumulation begins, the first stage of it, and then it starts distributing down or expanding down, starts reaccumulating again, So once it's finishing reaccumulating, it taps into that array, starts going up, takes out that accumulation here, then it starts redistributing or reaccumulating, whatever. Then it goes up, expands. Once it finishes expanding or taking out this next set of liquidity or whatever liquidity it takes out, then it starts reaccumulating or redistributing, and then finally expands one more time into that take profit zone. Now I want to clear out a few little things here when it comes to the stages of accumulation and market maker models. So the first thing is the number of stages. There can be more than 2 stages of accumulation and redistribution in market maker models. So there can be 1 or more than 2 stages. And the key points of all this is flexibility. The exact number of stages depends on what the price is presenting at that time. You might not get 2 stages of accumulation. You might only get 1. You might only get 3. It can vary. Sometimes in one phase of the program, so for instance, right here, you might have only 2 stages of accumulation. And then once it starts selling off, you might actually have 3. Anything can happen. Okay, so just be ready for that. Cycle variability. There may be multiple accumulation or distribution cycles before a significant market move. So always keep that in mind. So while 2 stages are common, the market can present several stages or less depending on market conditions and price behavior. Always be ready to adapt, guys. That's always what I've been trying to teach you guys. Be ready to adapt for anything at any moment, because price is not very predictable. It is very hard. The only thing we can do as traders is make educated guesses. Okay, please study this part of the video or of the section, because it's very, very important. All right, now let's talk about market maker models on the higher time frame and lower, part 2. So here you have that higher time frame example, and we have our market maker sell model. So here you actually have this lower low, and then up here would be your higher high, and then market comes down, creates a lower low. And what does it do? It creates an inefficiency or a fair value gap. And what we need is for price to come back in and fill some of these unfulfilled orders. Now you will see price create some bullish momentum, which would be the buy program. As you can see here, the buy program can be seen on the 1 hour time frame. So if you drop down from the daily to the 1 hour or any other time frame, you could see that the buy program is initiated. And then once it's done filling in whatever orders it needs to fill, because it won't always fill it in, or sometimes price might overfill and you'll see it wick out over that fair value gap and then continue back down. That is where that sell program starts, and you'll see it'll create that lower low again, comes back up, creates the same process, and then goes back down. But basically that is what you will be seeing, or in theory that is what you want to see, right? So again, for example, you'll be on the daily, you'll see that inefficiency, price comes back up. Somewhere in here there might be a low or a high inside of this fair value gap, and maybe that's what it's going to seek. After that, it'll come back down. Pretty easy, right? We will use the market maker sell model, for example, when in higher time frame bearish conditions, price can have an inefficiency or fair value gap and moving lower. So what will price need to do? It will need to rebalance itself, and that is where the buy program in a market maker sell model will begin and target the fair value gap or a premium array resting near or above the inefficiency. The buy program can also be seen as the retracement leg in a market maker sell model. You can trade in the buy program, although it can be more risky, which is why many traders prefer waiting for it to finish and trade the sell program instead. And here you have the market maker buy model, but it's essentially the same thing, just inverse all this stuff that I just said. But I gave you an example so that way you guys can refer to it. All right. Okay, so real quick, I want to go over the type 1 reversal on the market maker sell model and market maker buy model. Now, as you can see, you have the buy program. It initiates and it'll tap into the higher time frame array while causing a break of structure / sweep of liquidity, goes down, creates a change of character or a market structure shift, pulls back or reaccumulates and then goes down. That would be usually how you would identify a type 1 reversal model. And then the same here for a market maker buy model, right? You have that sweep of liquidity or that breakup structure towards the downside, taps into the higher time frame array, comes up, causes that change of character or market structure shift, pulls down, reaccumulates or redistributes, and then initiates that market maker buy program. So real quick, you want to have a sweep of the previous high, just going over the steps again. Next, you want to have it tap into a higher time frame array or any array. Like I said, it doesn't matter. It can be the same time frame or higher time frame. And then number 3, price reverses with a fair value gap on the same or lower time frame. So I want to actually add that on here. So you want to see a fair value gap be created before that breakup structure. You want it to rest up there so that way when price reaccumulates or redistributes or creates that pullback, you wanted to see it come into that fair value gap to then break that structure here to confirm the market structure shift. That is usually what you want to see. And then same thing here, just repeat the steps on your own so you can practice. Now, I want to also talk about SMT as being part of those reversals. So here you'll see I have an example for the buy to sell program and the sell to buy program. So on your main asset that you're trading, you'll see that breakup structure or that sweep of liquidity with that possible change of character or breakup structure occurring. Now, let's say you're looking at the other asset and you're seeing that it actually failed to create that breakup structure, even though on this side you saw that structure was broken. So that is a way that you can use SMT to confirm that you will have a change of character or a market structure shift. And then once you see those breaks of structure on both assets, you can use that or SMT divergence as part of your confirmation to begin looking for sells or that we have entered that sell program. And same thing here for that buy program. You see that it broke structure or it swept liquidity here during the sell program on the main asset. And then you go to the correlated asset, you see that it failed to break structure or failed to create that lower low. And as you can see, it also caused a break of structure or change of character. And same thing here with that main asset, you can use SMT again to confirm the shift in program, which in this case, it would be a buy program. Now I've embedded and I will link in the description a playlist that I think is going to be super helpful when it comes to SMT. I don't trade with SMT, I never have and never will. I just think it's more work and you're just adding more confluences that really doesn't truly increase your win rate. I mean, it's just part of a trading plan that some people have. But personally, I don't find it useful. That's why I don't really teach it, and I probably will never teach it in depth because I just don't find it useful. But I did leave a playlist for you guys to check out. I think these videos are probably more valuable than stuff you pay online. So please take a look at them if you want to learn more about SMT. If you don't, then you can continue with the video. And don't forget to like, subscribe, and join the Discord if you have any questions. Okay? Now, talking about that fair value gap. If no fair value gap is present, then no breakup structure is valid. Now, on the other hand, you don't have to close above or below, depending on the trend, the previous swing point. As long as you have a fair value gap, you're good. So here you can see that there was that sweep of liquidity, taps into that higher time frame array. So you're going from a sell program, right? It sweeps that structure here, taps into the higher time frame array. And what does price do? It goes up, creates a fair value gap with the breakup structure, comes down, taps into that fair value gap, and then goes back up. Now here you can see for the market maker sell model, you were in a buy program, so you can see that price swept some liquidity and tapped into that higher time frame array or point of interest, broke some structure, barely broke it though with this wick. So price didn't actually close below this little low right here, but it created that fair value gap. So if price would have just wanted to come back up without closing down further, it would have been just fine. But sometimes you will see something like this where price at first does not close below it, and then it'll try or it will close below that structure point or that swing point, but sometimes it won't. Sometimes it'll just wick into it, create the fair value gap, price goes into that fair value gap and then goes back down. And as you can see, you have that small internal low overlapping with this fair value gap. so it makes it even more higher probability. But that's just little stuff I learned over time. Now real quick, I wanted to show you this bonus. So you will have, let's say, a daily time frame, right? You'll be on the daily time frame market maker sell model. You see prices going up, it's going down, sweeps that liquidity on that higher time frame, and then once it's going down, it's creating that fair value gap. But let's just say price, the body of a candle closes below the opening price. It can be any opening price. We've already gone over this during the AMD/Power 3 video. That could be considered a change in state of delivery. Okay, so as long as it closes below that opening price, you are good. So let me go over it real quick. When price breaks through the opening price of these candles, it then becomes an order block. This order block is confirmed and becomes high probability with the presence of a fair value gap. Price can do one of these three things. Price can continue further to sweep some more liquidity or rebalance an inefficiency before retracing into the fair value gap. So sometimes it'll close below the opening price, takes out whatever liquidity is in here, or maybe taps into a fair value gap, and then it'll come back into this one right here, the fair value gap that essentially pushed the price down through the opening price. Now I believe I went over this part. Price can retreat into the fair value gap after breaking through the opening price. Price can simply continue moving away from the opening price without retracing into the fair value gap. So yes, that can happen. Sometimes you will have a fair value gap on that higher time frame and price might not even come back into it. It can happen, so be very, very aware of that. Don't get afraid. Don't think that you misread something or that you misread the model. Sometimes price just does not retrace into it. It happens. Price can exhibit many more behaviors, but these are some of the most common ones seen. And again, same thing here. You'll see price sweep that liquidity, right? While it's in that sell program, sweeps that liquidity, comes up, just pushing up, creates that fair value gap. That fair value gap pushes price through the opening price. Price then closes with the body over the opening price, sweeping some liquidity or entering into a fair value gap or some kind of point of interest. And then it'll either retrace into that fair value gap or it'll simply keep moving up. Now for part 4, I'm going to get pretty specific here. Okay, so let me zoom in real quick for you guys. And what I want to first focus on is this area right here. So when you have a higher time frame level plus some form of liquidity under it or in it, it could be a high inside of a fair value gap, doesn't matter. Once price reaches that level, there is a higher chance or higher likelihood that this is where the market will begin to reverse and start the new program. So if you're in a market maker sell model, it will start creating the sell program. And then if you're in a market maker buy model, it will create the buy program, targeting what? The initial consolidation or your point of origin, and it'll take out whatever liquidity is under here. Or if you're in a market maker buy model, it'll take out whatever liquidity is resting over it over here. Now from the point of origin or your initial consolidation all the way to your higher time frame level where price is expected to touch or come into, that is what is known as your BDR or your buy side delivery range. That is the area where you will be looking for some setups or some areas where you could start buying into. Or if you're in a market maker buy model, it will be from here all the way down here. And this is where you'll be looking for your short setups. So this is you're assuming that price will reach this level. That is why you will start looking for those setups as it's going down. Now again, I don't recommend you trading towards these levels because price could reverse at any moment. But if you are one of those people that want to take that chance, that is how you will look at it. So now that we have that figured out, the next thing you're going to do is copy these fib levels, because what we're going to do is do something called grading. You are going to grade your buy side delivery range, and you're going to put your fib level from your point of origin all the way to your terminus. And what you will do is grade it by using 25% increments. Each area is a special place, or you could say an area that price typically does something special. So for instance, between the 0 and 0.25 area, this area right here is where you would like to see the initial consolidation, which would be this one, right? Then between the 0.25 and 0.05 area is where you would typically see the first stage of accumulation or pullback into the initial consolidation. So sometimes you will see price pull back all the way down here, or it'll just create a small pullback between this area, or again you could just see that accumulation. And sometimes you will even see setups where in the pullback you will find maybe a sweep of liquidity taps into an order block, or maybe it'll tap into a fair value gap. That's where you will hunt for your setups, and you can target the next level. Okay, now in the 0.5 level or the 50% level, you should see a measuring gap or a breakaway gap. So if you were to take your fib with a standard deviation or with some standard deviation settings, and you draw it from your point of origin, so from here all the way to the breakaway gap, and project a one standard deviation higher, so let's just say you put it somewhere around here, you should get a pretty close estimate of where the high of the BDR is located at. So whatever is around here, right, you should be able to get a close estimate of where that BDR range should be, especially if there's a point of interest or array in that area. And it also confirms that we truly are halfway into the buy or sell program, and in this case we would be in the buy program. So again, you would anchor your fib, project some with your standard deviation settings. I'll show you some in a minute. You draw it to that breakaway gap, and then you project that one standard deviation higher, and it should give you that area where your one standard deviation should fall into. Okay, now between your 0.5 and your 0.75% area, you should find the second stage of reaccumulation, or again another pullback. But the pullback usually isn't that deep. Afterwards, you should see an explosive move up or down, right, or down, because that is where the market makers not like to give people a chance to get in, or that is where people get in last minute, and all those orders start accumulating very quick, and then taps into that higher time frame level that the market makers are waiting for price to tap into to begin selling off. So pretty easy. All you do is revert it and do the same thing for this. It's literally the same thing for the market maker buy model. Now you might want to copy my fib levels here. These are the standard deviation levels that I'm going to use in this example. Now there's two things that you could do with the standard deviation levels. The first one is you draw it from the beginning of the consolidation all the way up to where your 0.5 level meets the top of that consolidation. Okay, and what you will do is use the rest of the standard deviations, and you will find areas of where price should accumulate or pull back in between those areas, which makes them even higher probability. So if you see whole numbers around the graded levels that we talked about earlier, that is even higher probability chance that if you do get into a setup, it will more than likely work out. Now you don't need to use this part right here, right, the standard deviations, if you don't want to, but you can, especially if you are going down to a lower time frame and finding those trade setups. Now you would also do the same thing here, but instead of using the 0.5 level over or under, in this case, right, under the consolidation, you could actually use the 100% level, or the 1%, or the 1 level, whatever you want to call it. So you would draw your fib from here all the way down with that 1 level under the consolidation, and then you will still get the levels aligned perfectly, right? You should get them to align perfectly. But now the deviations changed in terms of numbers. So instead of having a 1 at the 0.25 level, you might have a 2, right? So you'll actually be a standard deviation higher, but it's all generally the same thing. It does the same thing. It serves the same purpose. It's just up to you and how you want to do it. Okay, now I kind of added this part a little last minute, but real quick, you will shift things around once the new program begins. So now that we are in a sell program targeting that consolidation, and I'm speaking in terms of the market maker sell model, you will kind of reverse things around. So now your terminus is actually the consolidation, and your point of origin is actually the top where price reversed to create that new program. And you will essentially grade it the same way. Now it's easier because you can start your fib from the point of origin down to the end where your terminus is at to find your sell side delivery range. And then same thing here. Price starts changing program, going from a sell to now a buy, targeting that consolidation or your terminus, and you can anchor your fib from the point of origin all the way up to your terminus to get your buy side delivery range. Now I'll go over how you can figure out how far price is going to go, but for now I think it's very important that you understand that these things can switch as well. Okay, so continuing now on part 5, how far can price go past the initial consolidation? So real quick, we're going to use a very interesting technique called calibration. So what is calibration? With calibration, you are finding a pip range below/above the initial consolidation in 5 pip increments with a higher time frame level or array near that range. So when I say below, I'm talking about the market maker sell model, right below that consolidation. And when I say above, I'm talking about the market maker buy model above this consolidation. Now, between the higher time frame level or array and between the consolidation, so here and here, you will have those increments. And if between 5, 10, 15 or 20 pips you find that higher time frame level, or it can even be on the same time frame, or you just find an array that happens to land in these increments, that is usually a target that you can go for if you're in a short sale. And same thing here, if you are in a buy trade, you would typically want to find an array that rests around the 5, 10, 15 or 20 pip levels. Now sometimes you can even find a rounded price level. It could be like 000, 500 or 100, that sits between the higher time frame level / array and initial consolidation. Sometimes you can even get up to 50 pips, right? So instead of just going to 20 pips, you can go up to 30, 40, 50, or 20, 25, 30, 35, stuff like that. It's pretty subjective, honestly. There's not a specific target, but if I was you, I wouldn't be so greedy. I just take what I can get or whatever's closest to me or whatever's near your standard deviation levels. But that's a whole other thing, okay? But yeah, initially that is what you can do, or a technique that you could use to find how far price can go. Now, I also want to talk about the manipulation swing, which is the swing that took out the short-term high, and there's also a short-term high here, right? So this manipulation swing, you'll see take out liquidity, tap into the higher time frame level, and then do what's called a smart money reversal. I will talk about the smart money reversal in a bit, but it's very important that you can identify this manipulation swing. Now, this part right here occurs after the final stage of accumulation, which tricks buyers into entering long. That's why it's called the manipulation swing or the manipulation leg. You enter into a long position and then sadly get stopped out once price reverses on you. And then same thing here, you have another one, right? Manipulation swing here, taps into the higher time frame array, reverses due to or causes it with a smart money reversal, starts going up, targeting that liquidity here. Now, something you can do with your standard deviations is you could go from here, right? You anchor it from here down to this part of that manipulation swing. Now, if you have any of these standard deviations that overlap with these areas of accumulation, that is high probability areas of where price could reach and pull back from or accumulate. So if you, like I said, anchor it from here to here, and you wait for price to come down, and let's just say the 2 standard deviations, you can see that price can touch and then reverse up a little bit or pull back and then come down. And then as you can see, the 3rd standard deviation happens to align under here between 5 to 20 pips. That is also another high probability area. So real quick, 2 to 3 standard deviations of a manipulation swing is pretty common. You can look for those 2 to 3 standard deviations, but it's not always going to be that. It can happen, but if I was you, I'd just be ready for whatever the market gives me. And then when these standard deviations align with any other points of interest or like fair value gaps, order blocks, whatever, it is a high probability of distribution. So remember, we call these areas redistribution areas. That is usually what they are called, but I always like to say there's pullback areas, or areas where price can come down and reprice itself, because let's be honest, price does a number of things. It doesn't just redistribute or reaccumulate. It can do many things. And then 1 to 2 standard deviations of a manipulation swing is a good area to look for redistribution. So again, just a quick recap about that area. 2 to 3 standard deviations from a manipulation swing is pretty common. When a standard deviation aligns with any other types of arrays, that means there is a high probability of price reaching it or having some kind of reaction from it. 1 to 2 standard deviations is a good profit target, starting off and finding areas of redistribution. Now, a real quick bonus that I want to include here is that there's more than one way to use your standard deviations. You can anchor it from the new program. So if you're in a market maker sell model, you can use the sell program once this area finishes accumulating and breaking down. So going down here, as a matter of fact, let me zoom in for you guys a little bit. So here, as you can see, you can anchor your fib, from here to here, and that'll give you your standard deviations. And if one of these aligns with an array, then that is a possible high probability target. And then same thing here. You would anchor it from here to here, and then you'll get maybe a 5 standard deviation, right here, or a 5% level, and that is a high probability target if aligned with a higher time frame array or any form of array. It doesn't have to be a higher time frame, and it can be anything from 5 to 20 pips or even 40 pips, but preferably try to keep it as conservative as possible. And then another way is that you can actually use it from a breaker block. So here you line it up from the top to the bottom, and then again, if your standard deviations align with anything down here, a point of interest, an array, whatever, that'll work too. And then a breaker block for the market maker buy model will look like this, right? Line it up from here to here. Find any area where a deviation or standard deviation aligns in, whether it's an area of accumulation or somewhere over here you find an important point of interest like a fair value gap, and it aligns with this level, that is also a high probability target. All right, so now I want to talk about the new calibrated terminus. How do you get that? You get it by the 5 to 20 pip increments. You found that special level, whether it's on the higher time frame, same time frame, whatever level or array it is that you want, plus your standard deviations happen to overlap on this higher time frame level. You will now begin to grade it again, but this time you will now have a new calibrated grading range. Now, real quick, in the 0.25 level, you will find the first stage of redistribution will typically occur, and a breakaway gap will also likely form. In the 0.5 level, your measuring gap or another breakaway gap can form, but really all the measuring gap is an unfulfilled or unfilled fair value gap at the middle of the range. This gives us an extra confluence that we calibrated our terminus correctly. And on the 0.75 level equals normally see our second stage of redistribution and even a silver bullet setup. So if you happen to find a silver bullet setup around this area, you're good to go. All right, so in this chapter, we're going to talk about trading strategies and techniques. Let's begin. Now, when it comes to these trading strategies and techniques, I'm really just talking about techniques that you can use for trading strategies. I should have probably changed that, but we're here this far now, ladies and gentlemen, so it's too late. Anyways, when I was talking about the smart money reversal, all that really is just a fancy way of changing character or a market structure shift, but it's a little bit more fancy, right? Or some people know it as a change in state of delivery. I don't care what you call it. Point is, we're looking at the same thing. So that's when you're essentially going from a buy program to a sell program. Now, typically, the best way that you would want to see a smart money reversal is when there is a sweep of liquidity or a sweep of that previous high or a breakup structure, however you view it, and it taps into that higher time frame array. And let's just say that there was also some liquidity that it swept to make it even more higher probability. Price will then shoot down. It can either shoot down rapidly or slowly, but usually it will shoot down pretty quickly. Take the liquidity under here, pull back up. Maybe it might go past this area, maybe not, and then shoot down, reversing on you. It essentially entraps traders. That's really all your smart money reversal is. You can also pair your smart money reversals with the different forms of reversals that I showed you, right? There's that type 1, which is the one you're looking at now, or the type 2. There's the other types. I think there's like 2 or 3 more. That's really where smart money reversals come into play, right? But it's like I said, it's all really just a change in state of delivery. That's when you're switching from a buy program to a sell program, or a sell program to a buy program, but you're doing it in a very technical way. All right. Now, in the next chapter, I actually get into more trading strategies themselves, but just a quick way that you guys can trade it is once it breaks past this first area of accumulation and price pulls back into that area and you see some rejection, like some candlestick rejections, some engulfing candlesticks, you can actually enter and then set your stop loss over it, right here over this area. Or as soon as it breaks out from the accumulation levels here, once it breaks out down here, you can enter somewhere over here and then put your stop loss either in the middle of this area or over it. Right, that is one way you can do it. Now I do have an example for you that I will go into, showing you more on the chart itself, that way you guys aren't so confused. But I also will link some resources that you can use for trading this. But I mean, guys, all this really is just going from IRL to ERL and then ERL to IRL. It's just a really fancy way of doing it, but it's all the same thing, right? I mean, you can look at Sir Pickle's channel and he's doing the same thing, right? He's going from internal resting liquidity to external resting liquidity, or external resting liquidity to internal resting liquidity. That's really all market maker models are. It's just super fancy. All right, it's way too hyped up. That's all I'm saying. Now for this chapter, we're going to talk about accumulation and distribution blocks. Now again, shout out to Ali Khan. His resources have been a huge help to me when it came to making this video. So shout out to him. I will link his channel down below. Check him out. He's a pretty good trader. I don't really think of him as much of a scammer guru kind of guy, but I mean, do your own research on him. So it's up to you. I'm not trying to promote him or anything. I'm just saying he wasn't that bad. That's all. All right, so now let's talk about accumulation and distribution blocks. So when it comes to distribution blocks, all that is arrays on the left side of the market maker sell model, and for the accumulation block, it's arrays on the left side of the market maker buy model. Now for the market maker sell model, the way you would find these distribution blocks is they are essentially consecutive down close candles near the end of an accumulation. So they can be found here or here. And typically what you would also like to see is for a price to kind of invert it. So that'll kind of make it a high probability distribution block. And then here, the accumulation blocks are consecutive up close candles near the end of an accumulation. Now, if you find a fair value gap on the inverted side, or in other words, the buy side of the market maker buy model, and it happens to overlap with an accumulation block, that is a high probability setup that you can find that he calls the A block model. And then for the market maker sell model, if you find a fair value gap on the sell side or the sell program, and it happens to overlap again on the distribution block, and you see price retrace into that fair value gap with that distribution block, you are good to go for a setup. Now I have a market maker buy model example that I want to show you real quick. Now here you can see our stages of accumulation, right? And now price has made the smart money reversal. We're going up. Here's a little bit of accumulation, and then here you have that accumulation area, and I'm using these last two as my accumulation blocks. Price inverts it. You see that it creates a fair value gap around this area, price retraces into it, and then what does price do? Keeps going up. That is how you will typically trade and look for these kinds of blocks or models. Now, I want to remind you the distribution cycle, how it usually works, because this is very important. What does the distribution cycle usually do? And I'm talking about this area right here after the first program is completed, right? So in this case, I'm looking at the sell program. The distribution cycle usually does what? It runs liquidity. It can also rebalance itself or run stops. It also does a couple of things like mitigation. And then after it mitigates, what does it do? It can create either more liquidity after it mitigates an area, or it can continue going down. Sometimes it'll do all of these things at once. It'll run liquidity. After it runs on liquidity, which would be this side, right? For example, it'll run liquidity here. It'll come down a little bit, pull back, rebalance itself, go down, maybe mitigate through this distribution block. Maybe it'll come back in, or it'll just continue going forward, right? So always keep that in mind. All right, so let's talk about accumulation and distribution blocks part 2, but with a little bit more in depth, with a few more things, I guess, or an extra model here and there. So we've already went over this part, right? You should know what it is by now. After you see your change in state of delivery, whether it's up here, the first few candles, right, that break structure towards the downside, or you get that market structure shift here after breaking past through the last area of accumulation, which I prefer to do, right? I prefer to wait for that area to break through and cause that change of character. But I know there's a lot of people that like to wait for those few candles that are near that higher time frame array to form and then price slightly break through under him. That's on you. It's just a little more risky for me to consider that a change in state of delivery, because price could always slightly move up. But again, it's up to you. Now, once you see that market structure shift and you find a breaker inside it, and you pair it up with a fair value gap on the sell program, if you see that fair value gap inside that breaker and you see price retrace into it, that is a good position to get into for a short setup. Okay, great position. And if you see that price causes another break of structure, you could also do either a re-entry or you can get in for a second position. And I already talked about the distribution block, right? So I'm not going to waste any more time, but fair value gaps could form either slightly before it, in the middle of it, or a little bit after it. Either way, you're good. You can target your new higher time frame level or calibrated terminus. And just basically the same thing here for the market maker buy model. You can always refer to this as a template or as an example, whatever you want to do. But I would highly suggest you go on the charts and see if you can find something like this. See if you can find your change in state of delivery, or if you rather wait for your market structure shift, and see what works best for you. Now we are going to get into time and market maker models. This is going to be pretty tricky, but if you stay with me and you follow along, you're going to see why it's very important. All right, so part 1. Data points are specific open, high, low, and close that happen under a certain time period. Okay, so there's a specific open, high, low, and close like around 9:30, right? And that is when the data points have aligned with a certain time window. The algo will send a very specific type of instructions, which is in essence what a macro is defined as. Now those instructions could be to consolidate, expand, reverse, or retrace, right? Pretty easy, pretty simple. All right, so part 2. Now I already talked about this sort of, I guess you could say, on the AMD Power of 3 video. Well, not sort of, I did talk about this. And I would highly suggest that you do look at that video if you haven't, okay? Because it's going to be a little confusing if you haven't seen it. It's very, very important, okay? So on Mondays, you will usually see a consolidation. And then Tuesdays is your first stage of accumulation. And then Wednesday is the expansion phase plus a possible retracement. Thursdays is the high of the week, or that is usually when it is formed. It doesn't always form on Thursdays, but that's usually when it forms, and generally happens around the New York session. Smart money reversal also generally happens around that day. See right here. Friday is the first stage of redistribution, and you can also find your TGIF model. And then Monday, you can look at the second stage of redistribution, and your silver bullet could also show up. And let's just say it does show up. It's a high probability trade because it ends on a Monday on the second stage of redistribution. Next is because of the retracement into the first expansion phase from the buy program or sell program, depending on the market maker you are in. So really this was just the part I was trying to finish reading. Now I am looking at this from a 2-hour time frame, but I'm trying to get a weekly range. All right, so it can be on any time frame. It can be on the 4-hour, 8-hour, whatever the case may be. I'm just using this as an example. All right, and then again here, Monday it accumulates, Tuesday first stage of accumulation, Wednesday expansion plus retracement, Thursday the high of the week, Friday you'll have your redistribution / TGIF model, and then Monday your second stage of redistribution plus your silver bullet setup, etc, etc. So it's really easy, guys. You could really just look at this. Like if you want, you can just pause the video and just go through it yourself, and you'll be fine. Like you could just refer to this at any moment, at any time during your trading week, and bam, real easily you'll be able to recognize, oh, this is why the day is doing that, right? If you know where you're at in terms of the days, you'll be good to go. Now that is just in theory if what ICT is saying is true. Okay, now chapter 8, market phases and patterns. This is going to be pretty good. All right, so AMD and market maker sell model. So yes, ladies and gentlemen, you can have AMD in a market maker sell model. So let's say you have these stages of accumulation on the higher time frame. So let's say you're on the daily. If you were to drop down to like a 4-hour time frame, you could find stages of accumulation, manipulation, and distribution, or mini market maker models. These happen all the time. Okay, if you haven't seen my previous video again on AMD / Power 3, you really need to watch it. You're missing out, because it's going to open your idea or your world to a whole other thing. But yes, on that lower time frame, you can find AMD / Power of 3 models or setups. And then same thing here for the market maker buy model. You will find AMD in the form of accumulation, manipulation towards the high, and then distribution going down. Now AMD doesn't look exactly like this. When it comes to the manipulation and distribution parts, that is how it will look in terms of market maker models. It looks a little different when you're putting it together with the Power of 3, because the manipulation looks a little different, but the idea or the concept is generally the same thing. Now yeah, you can combine it with the Power of 3, or essentially AMD and Power of 3 together to trade, like create an actual trading strategy, but I don't want to get into that. The video is already long enough, and that'll be like a whole nother thing on its own. So if you want me to make a video specifically on that, I'm gonna have to see the likes and the subscriptions to go up, because this is a hassle already as it is. Like it is not easy. I enjoy it, but sometimes it's a little too much. But you can always click on this link that I have embedded into the file, or you can check the description down below, and I've linked some great videos together that you can look at, that you can use to create a strategy with the Power of 3 and market maker models. All right, so chapter 9, application and resources. You're gonna like this one a little bit better, okay? I promise. All right, y'all, so this is the chart example that I was telling you guys earlier. So fair value gaps, liquidity voids, and volume imbalances used together can be a strategy on its own. Yes, it can. So remember, I was telling you that all market maker models is going from ERL to IRL or IRL to ERL. So as an example, let's say you have a monthly fair value gap that you saw price was going to come into. Now that you see price did come into it, and you get that change of character and market structure shift, you can start buying your way up to ERL on the 15-minute time frame, or ERL that you also found on that monthly time frame, right? It could be that external high, if from what you're looking at is a market maker buy model, right? So this is the sell program, this is the buy program. So as you can see, if you're in a kill zone, once your kill zone hours have began, and you see that a setup like this happens, it's high probability. Okay, another way that you could also enter is, let's say the next day you missed out on this trade, and you see that you find that break of structure towards the upside, and you see that we already passed the first stage of redistribution. What will price most likely do? It'll retrace into a fair value gap created during the Asia session, come down, taps into it, respects it. You see that engulfing candle. You can put your entry here, right on that engulfing, stop loss under here, and then target ERL. right? Very easy, very simple. And by the way, if you guys are studying this chart and you don't know what the heck you're looking at, the blue and sort of green are the kill zones. I believe the blue ones are Asia, and I believe the green are New York, if I'm not mistaken. And these shaded gray areas are the accumulation zones. So study the chart, look at this example specifically, and I want you to find setups in this example on your own, from the sell program all the way up to the buy program, and you'll realize how easy it is to find setups without getting so freaking technical, so lost in all the technicalities. It's so easy. There's no really need to complicate any of it. It's just that people do it on purpose to try to sell you something, and I have nothing to gain here. Everything's for free. So check it out, study this example, and if you can, go on the charts and study it on your own. Now lastly, application and resources. So first thing is, you can apply market maker models to literally anything. For example, the Judas swing model, unicorn model, turtle suit, RL to ERL, which is the best, supply and demand, I love supply and demand as well, support and resistance, entry models such as the 2022 model, FED, breaker plus fair value gap, etc. Next, if you really want to learn market maker models, take a look at that playlist, okay? It's really good. That's all you need. You don't need to buy an expensive course for like $300. You know what I'm talking about. Them dudes on Twitter, you know what I'm talking about. You don't need to spend your money, man. It's all for free, okay? Just look at the playlist. Look at all of them. I promise you, you'll be an expert at this by the time you're done. Again, don't think that market maker models are the key to being profitable. There are much more profitable concepts in this space. Market maker models just have a lot of clout from mentors selling their courses. Believe me when I say that a lot of these mentors that you see online, what do they include? Market maker models. Why? Because that is the biggest thing that has been talked about in this space, from ICT and to anyone claiming they've been the most profitable trader because of it. Okay, you don't need to spend your money, guys. Please don't do it. Don't do it. In my opinion, you need at least 100 hours of total chart time to get down any concept you want to learn. I believe the 100 hours rule has been made by someone else. I don't remember who, or maybe it was like a study done. I forgot where I read and heard this from, but it's true, guys. You really do need to put in at least 100 hours. I can't tell you how many times I've literally dreamed of price action. Like, I will see an actual chart in my dreams. That is how much time I used to spend on the charts. I would stay till like 1 or 2 in the morning looking at charts, back testing, just because I was so addicted to it at first. I loved it, and I still do love it. Now, if you want to read a book, this is actually a book I really wish I would have known about and had at the time I started trading, especially if I wanted to learn ICT concepts or just trading in general. Is the book by Lumi Traders that explains the 2022 ICT mentorship. It's an amazing book, y'all. Amazing book that has also been a great resource in making these videos. Obviously, aside from looking at ICT's videos themselves, but some parts are pretty hard to explain, so I'll try to compare his words with other people that have simplified his content, and if I see that it makes sense together, then I'll put it in a presentation for you guys. But definitely check out Lumi Traders on YouTube. I will link their channel down below. Amazing. All right, we finally made it to the end of the video. Thank God. I know the video was long for you guys. Imagine how it was for me, shooting it, retakes, editing. I mean, it's a really lengthy process, so please don't forget to like and subscribe and join the Discord if you have any questions. As always, I like to leave you with a little biblical wisdom, and this is from John chapter 8 verse 32. Then you will know the truth, and the truth will set you free. So if anyone that is struggling with maybe something that they've been holding in inside and they need to tell somebody, this is the sign from the good Lord trying to tell you it's time to talk, time to fix things, time to handle business. Okay, so aside from that, I love you guys. I pray that you become the profitable traders you dream of. I hope you do. And if you need to talk to somebody, you can try reaching out to me on the Discord or emailing me, and I will do my best to reach out to you. Aside from that, that's all I have for you guys. Take it easy, rest up, get your chart time in, and I'll see you all in the next one. Peace.